For more in the markets, let's bring in Jeremy Siegel, Professor Emeritus of Finance at University of Pennsylvania's Wharton School of Business. It's not a Rorschach, I don't think, Jeremy, but would you say everything that you've been saying for the last 6 months, we're kind of seeing a lot of it either be exactly true or at least partially true?
Well, I remember on January 1st, I said we're going to have a 10 to 15% gain. I think we're slightly above that on the S&P. Of course, those Magnificent Seven have been a big contribution to that. But Joe, I mean, I only have one worry for next year, and otherwise I think it could be an absolutely great year, and that is that the Fed will be as stubborn in lowering rates if they have to as they were in raising rates, being so very late to the game and causing the inflation. I mean, let's face it, last week's data was weak. I mean, people talk about coming in for a soft landing. We're coming in for a landing. It's not guaranteed to be soft, not yet. Now, I'm not calling for a recession. I just want the Fed to be flexible. I was a little disturbed when Jay Powell said at the last conference, we're not even talking about lowering rates. I think they should be talking about it. Not necessarily doing it right away, but, the data is looking very different than it just did 3 or 4 weeks ago. Lower inflation, but also a lower level of economic activity that is trending downward.
But you had been talking all along since January, as you said, about that the money supply was actually contracting more quickly than you thought, that the conditions were tighter than they looked, that inflation was being overstated by certain components, and it was actually lower than it appeared. So all those things seem to have been borne out as more data has come out.
Yeah, and really, we've had no growth in the money supply over 2 years. You need about a 5% growth in that important liquidity measure to get a growing economy with 2% inflation. I'm a little worried. He better not go back to the narrative of the 70s. Oh, stop and go. We got to absolutely kill inflation. It's very, very different. In the 1970s, Burns pumped money in at 10% a year without fail. Here, Powell stopped it. It started going down. And of course, I became very alarmed. Then he eased up a little bit. It began to rise. Last 2 months, declining again. And now when I look at that real economic data, I said, he's got to be thinking if they lower rates, they'll get that credit going up again. We could have a real great year for 2024.
Well, would there be any reason to start cutting rates if we have a soft landing? Jeremy, why not? It seems like we normalized where rates used to be prior to the financial crisis. You think we should stay here, or are we too tight right now?
Well, I think we should uninvert the yield curve. And basically, it looks to me that we had peaked at 5% on that long end. Now we're 4.5%. Well, that means that we have to start moving down on Fed funds. I mean, it's not going to uninvert by the long bond going up to 5.5 and 6. I mean, some people talked about that a while ago. No, if we're going to uninvert it, we're going to have to bring it. We're going to have to start bringing it down. And just if we have very little inflation, 5.5% Fed funds is a very punishing real rate, even with the promise of AI and everything else. It'll be hard to overcome that. Look what's happened in the home building. Now we got good housing starts, but home building sentiment has collapsed over the last 4 months, and that is another area of softness you have to consider going forward. So, given inflation is licked, in my opinion, and I've said that for a long time, as you said, real rates are extremely high. With the jobless claims going up, by the way, we had a 2-year high, and in continuing claims, I think it's time to uninvert that curve, which does mean start talking about lowering rates.